Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Here we are with another episode of Black and White Market Minute on Life Planning 101. Matt Ervin and Aaron Kennedy with you today. Enjoying this beautiful Friday, right?
Absolutely beautiful.
Yeah, it's great. I hope everybody had a happy 4th of July, right? Family time.
Yes.
All of our team came back with all their fingers and toes, so no major accidents. That's sure enough a blessing there.
Yeah, it's always a great 4th when you still count to 10.
Yeah.
In two different places.
And you don't need to borrow anybody's digits. Yeah. No, that's great. So, Aaron, you did a little traveling, and I was excited to hear that because usually when you do that, you tap into some of the greatest minds out there. I know we listen to so much content and podcasts, and that's one way that we're able to see what everybody else is thinking. So I'm really eager to hear some of the themes that are happening, beyond us, right? It's beyond American borders. Some of this is beyond the global borders, right? There's talk of more moonwalks. Anyways, there's so much going on. But tell me some of the key things that you've been hearing.
I really like the guys that think outside the box. Not the first level effects, not the second level effects, but what's beyond that. And I got to hear some really fantastic stuff. Got all excited. I think I was texting all of y'all. Y'all need to listen to this and pay attention. But we're listening to, I think his name was Luke Groman, and he was talking about the bond market. And he's not very positive on it. And the biggest thing is if you're invested in treasuries, if you're invested basically in almost any debt other than some really high yield stuff, you're losing money. Think about that. If treasuries, right now we've been saying, hey, you got cash, get it to work. Mm-hmm. Right now we're buying 5.4% treasuries. That's fantastic. But inflation is 6%. Regardless of what the government said. We talked about this last time. Government tells us 4%, but our food's not increasing at 4%. It's way more than
like
gasoline. Yeah. So $500,000. And at the end of this year, I can only buy $94,000 worth of goods. Mm-hmm. But I made 5% on my treasury, still lost. I've only got $99,000 to spend right now.
That's an extremely interesting concept, right? Because we feel better about 5 because we frame it to a time when interest rates are nothing, and so getting nothing as an interest rate or 5% feels really good. But fundamentals, what is the only way to truly keep up with inflation? Invest in equities.
Yes.
So we get a little bit of that recency bias to say, hey, interest rates were 0. We can anchor to these 5% rates. We're feeling really good. We're going to outpace inflation.
Wonderfully put. Wonderfully put. Recency bias that explains it all. And we may be going back to 0. 5.4 feels good, but we're going, what's the saying my dad always says? Going broke safely.
Oh, okay. I was going the big print, little print, but
well,
either
that
way,
fits there
I
too.
think that's the government for you. But go, please proceed.
And you think about this when we're talking year-to-year stuff. Go out 30 years on the Treasury. Where are we at? 4%?
Yeah.
So if you're going to loan money to the U.S. government for 30 years, you got to take some things into effect here. What's interest rates going to be over those 30 years? Mm-hmm. And what is inflation going to be?
Right.
So you can still hit it out of the park if we do have lots of deflation. If interest rates go down, but that's a long time to guess. And, 4%, how much deflation actually has to take place before you feel good about that trade?
Right.
And it's not, I think listening, you can say, yeah, that's a little bit iffy. And if inflation stays higher for longer, it's going to be pushing people out of those government securities more and more. And we're going to get to the point that we're going to say no.
Well,
Equities are the only part in town, or assets. Doesn't necessarily have to be stocks.
When interest rates were zero, people were kind of pushed into taking risk that they weren't normally comfortable taking.
Yes.
Used to be that, I say used to be, CDs would pay 9, back in 70s or so, maybe 80s. 80s, okay. So, people could buy CDs and your grandpa would talk to you about buying a CD. Mine did, right? But when we got to kind of 2019, something like that, interest rates were pretty compressed.
Yes.
Okay, so people were forced out of fixed income into equities because they were trying to get some kind of yield. Right? So now, although we're getting 5, it kind of sounds 5 on interest rates, relatively speaking. It sounds like we're going to be forced again out of fixed income. So is that when we look at, obviously we're not forward projectors of returns, but when we think forward as far as trends in the market, are we looking at kind of an exodus of fixed income, and you're going to need to take some sort of diversification to real assets, equity risk,
absolutely,
hard assets, commodity? I mean, we talk about all the things, but
yes, absolutely, we're going to be forced to move somewhere that can actually better our lives. And like you said, this mass exodus has been taking place for a long time. Mm-hmm. Early on into my career, everybody was stuck on looking at PE ratios at 15. Mm-hmm. That's the average. If you buy under 15, that's value. If you buy over, it's growth. But that was the magic number. And I think people would kind of look at you very strange if you were to repeat that now. Because, all of a sudden 16 was normal, then 17, 18, 21. It's markets keep creeping up and getting more and more expensive. And this year, they're ungodly expensive.
Right.
We're right back to where we were in 21 on the expenses. Another one of the podcasts I was listening to GMO. I've been listening to them since I started. And they're big value guys, quality guys, and he was breaking down the market. And he was looking at the market from a value standpoint. If you take the value market, all the stocks that are cheaper than average, and then you take the very, very bottom part of that. So the 25%, the bottom 25%, so the cheapest stocks in the market. There's only been 2 times in history that it's ever been cheaper. It's at the 98th percentile of how cheap those securities are. Now, the other side, the 75% of value stocks above that, we're in the 98th percentile as being the most expensive in history.
So there's very fine, thin pockets of cheapness in the market.
Yes. Then if you flop over to growth, we're back to being the most expensive, not in history, but usually when it gets this expensive, we see some serious corrections.
Right.
Like, this is 99 expensive.
Well, but think about this, and I try to kind of reflect on the social trends, right? So go back to those days and how comfortable people were with debt. If you just reflect on generations ago, get your house paid off, get your car paid off, no debt, have cash, right? The generations that are newer, that are obviously now dabbling heavily in the market, they have no concept of time, for one, of what long-term interest rates really cost them. Money's been so cheap because they could get credit cards like easy, spend money they didn't have. The consumer spending has not slowed much. I mean, some, but not much. And we know that the wages or the consumer debt is growing rapidly still. Okay?
Very, very rapidly.
So people change their habits. Like, they spend like crazy, so they invest the same way. Recklessly, if you will, okay? So the thought of, I'm gonna say, if it's over value or growth, that particular price to earnings, Does it really matter what you pay for it if your buddy in the cubicle next to you just made $30 and so now you got to go make 60, but you paid twice as much for it? So PE multiples are long-term profits, right? If I buy an inexpensive PE versus an expensive PE,
Yes.
right? No concept of long-term interest rates. They have no concepts of long-term cost. So does it ever stop?
Yeah, I don't think so. I think the new normal, and y'all know I hate that term. It's different this time.
Surprised it fell out of your mouth.
Yeah, but if equities are the only game in town, it will become normalized that we're willing to pay more and more and more for these securities, and it's going to get to the point that it's going to be very, very uncomfortable buying these. I struggle with buying some of these really expensive stocks. I mean, even me, it's, paying 21 or, it's not near as painful as it used to be. I'm like, hey, it's not 30 anymore. Let's go. So it's going to be very interesting.
And it is interesting. And so some of the places, you talked about being able to find deals. We've looked into a lot of like private equity type stuff where you've got to find a way to invest different than the masses. And so we've obviously looked in and talked to a lot of that. Some of the hedge funds, private equity that kind of buffer against some of the liquidity. Now anybody with a smartphone can trade. That wasn't the case from even 10 years ago.
No. COVID turned on the masses. Everybody was bored in their house and they started learning to invest.
With any dollar amount.
Yeah. Go to Reddit, Wall Street Bets, and
Robin
it will
Hood.
blow your mind.
Yeah.
I'm surprised we haven't been regulated into not being able to do this anymore just because of Wall Street Bets. It's horrifying seeing the amount of money that people's lost.
Right.
But going back to the interest rates and the change of the markets, one of the most fascinating things I heard was AI. And let's think. If you can get a computer to set all your appointments, if you can get a computer to make your grocery list and have it delivered, run your appointment, order your goods, a lot of people are going to be out of a job. Lots of people are going to be out of a job. Now, how does the government deal with that? If the government's not getting the taxes that they're used to getting, let's say 20 years from now, AI is everywhere. Our unemployment's gone up 20%, and that this isn't bottom of the barrel jobs. We're looking at decent $60,000 to $100,000 jobs that have been taken over. Government's not getting their tax money. So what do we have to do? Number one, government's not getting their tax payments. They can't pay their debt, so that's going to push people further and further away from debt.
Right.
Again, but we're probably going to be looking at a time where our taxing system is completely different than it is now. We have to move away from an income-based tax and move it closer to a spending, like a national sales tax. Because that way they get it no matter what. Even if the government paid you your stipend, you go to the grocery store, you go to Walmart, they'll get their tax back that way.
Right.
If that's gone, and equities do what we're talking about, a lot of people are going to be living off of their investments.
Mm-hmm.
And those aren't really taxed efficiently enough in the eyes of the government. Mm-hmm. So that means they're not getting to tax it as much as they want.
That's right.
So there's going to be lots of changes. And just like looking back at your iPhone and how much your world's changed over the last 15 years, that's a very short time frame. So where are we going to be at 15 years from now?
That's an interesting question.
Once things start changing, it's going to continue to roll downhill.
Right.
And change will be faster and faster and faster.
Well, and what's the exponential growth of technology? Or there's a formula for it.
Yeah, that's Moore's Law.
Right.
And that was on semiconductors. Every year the semiconductor is twice as powerful and half the price.
Right.
And since the 70s, it's kept up with that.
Mm-hmm.
Absolutely kept up with that. And you go back to, let's see, there's been lots and lots of talk on cryptocurrencies. BlackRock and Fidelity and everybody else, the big guys, BlackRock, the people that control our government.
Right.
They went to the SEC and they're getting a spot ETF built. So more than likely they're going to get that.
Mm-hmm.
And on top of that, the U.S. government has been flirting with the central bank digital currency.
Mm-hmm.
So what's that do? What's that do from a cost for our economy? Think about not needing banks anymore. Banks are gone. Now, how efficient is this going to be? If we can move money more freely, we don't need tellers. We don't need bricks and mortar for our banks. We can go get a loan on a whim. Things are going to change at an exponential rate. And if you have your head buried in the sand and you're saying, that'll never happen,
it's already happening.
you're going to get left behind.
Yeah.
Just think of the last 2 years.
Right.
That had never happened. And you're like,
yeah,
it happened.
Yeah.
I don't know if there's been a time where so many conspiracy theories have turned out to be true.
Right. Yeah. That's truth theories, right? But that's a whole nother.
That's a whole nother thing.
But this is super interesting. So, Aaron, as we get wrapped up today, so what's our path forward, right? So when we're looking at positive pockets, we've got things that are a little expensive. We still have inexpensive places in the market, but overall, what's kind of a theme that we're looking at, midterm or kind of longer term?
I think you got to be in front of it. This new technology, this new way of life we're going to be seeing in 15 years, you have to take advantage of that. And we got to be thinking, yes, inflation is now higher than we want. It's probably going to be around for 5 to 6 years. Mm-hmm. But after that, prices will come down. The world that we live in is deflationary. So you kind of got to think, what can I invest in that's going to bring prices down long term? Mm-hmm. And that's going to be, a lot of that's going to be technology. Right. Every aspect of your life, technology is taking over. And you got to be willing to pay up for it. Maybe not.
Within reason.
Within reason. You got to keep your wits. But you got to be willing to pay up for it. And then on the flip side, I think you also need to buy some assets, some hard assets, mm-hmm. or companies that are investing in hard assets. These are things that you can hold, that you can make money off of. Mm-hmm. So, I'm not saying go out and buy a gold mine, but this is kind of what I'm talking about. You got a hole in the ground. Everything that you pull out of, you can sell. And if we're in an inflationary environment in the short term, hopefully you're going to be selling it at a higher and higher price. Mm-hmm. It doesn't have to be gold. It can be tractors. It can be real estate. But I think you put your barbell together and got to find a way that we can think about it and be okay. Mm-hmm. Prices are going to go up and down. 15 years from now, we want to be on the side that we look back and say, holy cow. Yep. It was a rough ride, but look where we are. Right. And how do you get ready for that mentally?
That's a whole nother challenge.
Yeah. Well, we got plenty of ideas, right. But we need to be starting to think about the future. What's coming down the pipeline and how do we take advantage of it? Not that we don't, but we're talking exponential. We talked about this earlier. What happens if we live an extra 15 years? Right. So, hey, if that happens, someone had to invent something mm-hmm. in the pharmacy world. So let's get some of that. Right. Everything's going AI. We're going to have robots everywhere, and maybe not R2D2, but just think about the Ford plant painting a car. Right. Robotics. You need to have some of that. Yeah. You need to have the companies that are really big into this AI. You need to have the chips that run mm-hmm. all the computers, and yeah, when you're doing that kind of stuff, your risk is going to increase. Your volatility is going to increase. Mm-hmm. So you got to do it smart. You got to stay plenty diversified. And even if you look at it a little bit different, that 10%, that's my semiconductors. And I know that goes up and down 30% a year.
Well, That's right.
So
when you frame it for the hold period, right? If that's something you're going to hold 15 years, let it be 15 years. You don't care. I mean, go back to the price of the cows, price of the milk, right? You don't sell the cow based on the price of the milk, right? And when cattle's way low, if milk's high, you're still making money. So keep it in context, keep your frame, and try to educate yourselves about the investor biases, because we're all human and we all succumb to them from time to time. So we want to make sure we're aware of those to say, okay, I know what's sneaking up on me. Let's put it in check.
There's a saying out there. There should be things in your portfolio that you absolutely hate.
Mm-hmm.
Absolutely hate. And why do you hate them? Because they're not performing today.
Right.
But if everything in your portfolio is performing, you're not diversified.
That's right.
And if we have a year like 08, like 2022, you can be wiped out.
Yeah.
And those things that you hated yesterday, those are the ones that save you when we go through these catastrophes in the market.
That's right.
So learn to hate things in your portfolio and be okay with it. Right. Be all excited about the stuff that's working, and just know the things that you hate are going to have their day in the sun, and it's going to be when you need it the most.
Right. So that's great. Well, we ran long today, but that's okay. I hope everybody enjoyed today's episode of Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.